Hello class, welcome to lesson number 4 of topic number 5, share capital. So in this fourth lesson, I want to talk about the purchase of own shares, by a company. Then I will also talk about dividends, the dividend law in respect to companies. So let me begin on the first of those items where we are talking about by purchase of own shares, by a company, where we are asking ourselves the question, can a company purchase its own shares? Or could a company, by extension, finance the purchase of its own shares? Now, we notice that there is a direct prohibition against companies purchasing their own shares or financing the purchase of their own shares. At common law, this is the rule in Trevor versus Whitworth, where the direction of the court is that a company must not purchase its own shares. A company must not purchase its own shares. Now, this is consistent with the rules that relate to the company's maintenance of its own capital. That the company's capital is the creditor's fund of last resort, and as such should be maintained. And all those matters, all those transactions of the company that go towards threatening the company's share capital, transactions such as reduction of share capital, transactions such as the company's purchasing its own share capital, all these are extremely regulated transactions by law in a bid to ensure the company's share capital remains fixed and known, remains unreduced, that there are measures that have been taken to ensure that the company does not waste its own capital. Now, despite this direction that a company must not purchase its own shares, the Companies Act gives us some special exemptions under which a company may be purchasing its own shares. So these exceptions include exceptions to the rule, that is exceptions to the rule in Trevor versus Whitworth. These exceptions introduce us to circumstances where a company may purchase its own shares. Now, one of those circumstances is during a redemption of redeemable preference shares. During the redemption of redeemable preference shares. This is if allowed by the articles, and all rules relating to redemption of redeemable preference shares have been followed. Rules that we have discussed earlier, such as the shares being fully paid, the shares being redeemed either out of the proceeds of a new issue, or if no fresh issue has been issued by the company redeeming them out of reserves and creating the share redemption reserve fund. We could also have a company purchasing its own shares in case of a valid surrender of shares by a member. This is a rare case, but very much possible, particularly where a shareholder holds partly paid shares, that the shares held by this member are partly paid. The fact that they are partly paid, they present a further obligation on that member to make payments for the balance, for the unpaid part of those shares. In the case this member is unable to make these further payments, in the event that this member is not able to discharge this liability, this obligation to pay for the balance outstanding on their shares, then they can surrender such shares to the company. This surrender in a way is to absolve them from that liability to pay for the outstanding amounts on their shares. The other possible circumstance under law where a company would be purchasing its own shares would be following or pursuant, following a court order for protection or for the purposes of protecting minority, for the purposes of protecting minorities. Where we have circumstances in the company, imagine circumstances such as a variation of class rights that is proposed and even voted accordingly, but we have some minorities who are contesting the variation of class rights on the basis that it is prejudicial to their own interests. We may have a court order directing that the interest of these shareholders, minorities actually, these protesting or these objecting minorities be absorbed by the company. In such an incident, the court could be directing the company to purchase the interest of these minorities, which the resulting transaction would be a company purchasing its own shares. So class, in these exceptional cases, they are presenting us to a scenario where we are going against the directions given by the rule in Trevor versus Whitworth, where the direction is a company must not purchase its own shares. However, we are saying in these exceptional circumstances, we can have a company purchasing its own shares. Now, by extension, we are also saying that a company must not finance or provide a guarantee, must not finance or provide a guarantee for the purchase, must not finance or provide a guarantee for the purchase of its shares, must not finance or provide a guarantee for the purchase of its own shares on the basis, on the same premise that we were not to purchase our own shares for purposes of capital maintenance requirements. However, we are also finding ourselves running into exceptions to this rule, that we have exceptional circumstances where a company may finance the acquisition of its own shares. Now, these exceptions include where providing finance or guarantee is part of the ordinary business of the company. So this could be a company in the financial sector where part of their business is the provision of financial assistance, that they're in the business of giving loans. So a loan has been obtained by a customer in the normal circumstances under which normal loans would be borrowed, where such customer also proceeds on to purchase the shares of this company with the proceeds advanced by the company. Then we have a situation, an exceptional circumstance, where a company has financed the purchase of its own shares. The other exceptional case would be where the company has a scheme, to advance, money or funds to trustees, to a trustee or trustees to acquire shares for the benefit of its employees, Now, this exception presents us with a situation where this company has set up a trust fund or has set up a trust for the benefit of the members. And this trust, part of the things it does is investments for the purposes of the members. Remember, these investments could be through the purchase of shares, securities in companies. So we are saying funds have been advanced to the trustees by this company where the trustees invest for the purposes of the members' welfare. These trustees could proceed on to use these funds in buying the shares of this company, advancing the funds. Now that presents us with an exceptional circumstance where the company is seen advancing funds, which funds are subsequently applied in the purchase of its own shares. Then finally, we have an exception where the company has a scheme. The company has a scheme to advance funds to employees. This is with an exception of directors. Except directors to purchase shares in the company, for beneficial ownership. So company law recognizes that companies could have a scheme, an arrangement within the company that they advance funds, they advance money to the employees of the company, with an exception of directors. Directors are excluded from this fund. They are excluded from this scheme, this arrangement of advancing money to employees to purchase shares of the company for beneficial ownership. This scheme is to make the employees of the company feel part of the company, where they have been advanced money for the purposes of owning a stock in the company that they work for. So this is the idea of purchasing of own shares by the company, that it is generally prohibited in the interest of protecting the company's capital. However, we have seen ourselves running into exceptional circumstances where companies can directly purchase their own shares. We have also seen circumstances where companies are allowed by law to finance the purchase of their own shares. Let me now look at dividends. Dividends. We are describing a dividend to be a member's return. This is a member's return for their investment. A member's return for their investment in the company. A member's return for their investment in the company. It is also seen as a share of the company's profit, that is paid to the members. The share of the company's profit that is paid out to the members. Now, the Companies Act presents us with certain rules relating to the payment of dividends to members, relating to the sharing of profits or paying of this return to the members. Rules of paying dividend. Rules of paying dividend. Now, as part of this continuing story of maintaining the company's capital, one of the paramount rules relating to the payment of dividend is that dividends can only be paid out of profits. Dividend can only be paid out of profit. Dividend can only be paid out of profit. That unless a company has realized a profit, then this company cannot pay dividend. And by the way, inherently, companies are not under obligation to pay a dividend. It is financial year end, we have made profits. The company is not under obligation to pay dividend to the members. But we are saying, should we be paying dividends? Dividends must always be paid out of profit. It is unlawful. It shall be wrong. It shall be against the law to pay dividends where the company is not making profits. It shall be seen as paying dividends out of capital. Now, what will be considered profits? The company has what we call the realized profit, the realized profit of the company. Now, from the company's realized profit, it may create some part of this realized profit as the profits available for distribution as dividend. Now, in arriving at the company's realized profit, it could be considering any gains. We talk about realized gains. Any realized gains from revaluations. Any realized gains from revaluations of assets can also be considered as the company's realized profits in this year, including the exclusion or the deduction of any realized losses from revaluation of assets that this company has done during this year can be excluded from the company's annual realized profit that year. So from the company's realized profit, the directors will designate part of the company's realized profit as profit available for payment of dividend. Profit available for payment of dividend. The other rule is that dividend is recommended. Dividend is recommended by the board. Dividend is recommended by the board of directors. Dividend is recommended by the board of directors. These are the persons charged with the day-to-day management of the company. So they are best placed to know how much this company can afford to pay as dividends. So it shall be their responsibility to recommend how much dividend is to be paid. Still relating to the payment, we are saying that dividend is approved. Dividend is approved by members. Dividend is approved by members at a general meeting. Dividend is approved by members at a general meeting. Now, this meeting could be the company's AGM, at which dividend is usually approved by the members. So the directors have recommended a dividend, then we have a meeting of members where that dividend is approved. Relating to the approval, we are noting another rule that the members cannot recommend. The members cannot, let me withdraw the word recommend and replace it with the word approve. The members cannot approve a dividend above the rate, cannot approve a dividend above the rate recommended, above the rate recommended by the board. Above the rate recommended by the board. So the board's recommendation on what dividend is payable shall be final. That in the GM's, the general meeting's approval, they cannot approve an amount beyond that which is recommended by the board. We are also noting that the company cannot pay dividend. The company cannot pay dividend if such payment will result to inability to meet its financial obligations. A company will not pay dividends to be unable to pay its salary to employees. A company will not pay dividends to be unable to pay rentals. A company will not be paying dividends to be unable to pay such expenses as are necessary for the running of this company. Now, once a dividend has been declared, something also happens that declared dividends, let's add the approval. declared and approved dividends, shall not bear interest, against the company if there is a delay, in payment. That the board has recommended a certain rate of dividend, which has subsequently been approved by the members at a general meeting. Now, the usual practice is that once the dividend has been declared and approved, within 42 days of such approval, the dividend should be payable. If there is any delay in payment of such dividend, the suffering members shall not claim interest against the company for delay in paying them the dividends due. The other rule still relating to payment of dividends is that the company may deduct any amounts. The company may deduct any amounts owed to it by a member from the dividend payable. That the company can deduct any amounts that they are claiming from a member from the total amount they are to pay them as dividend. For instance, imagine a case where we have borrowed some money from our company and we have been unable to pay them. We have not repaid such borrowed amounts of money. So this company has some claim against us. So this rule is empowering them to deduct such amounts that they are claiming from any dividend that is payable to us after the declaration of the dividend. Now, from these rules, we can start imagining a procedure that companies follow in the payment of dividend. What procedures do we follow when we are paying dividend as a company? We will begin from a board meeting being held to recommend a dividend. After a board meeting has been held to recommend a dividend, the company will prepare and update the company's register of members, because it is on the basis of the register that this dividend is payable. Then we shall proceed on to convene a meeting of members where this dividend payment is to be approved. So once the dividend has been approved, then we have a preparation and closure of the register of members so that we have no more additions to the register after the approval of the dividend. Then the company can proceed on now to prepare the dividend warrants, which are to be counter-checked against the company's register of members. Then checks can be prepared and sent to members in respect of the dividend payable to them. So class, that brings us to the end of our lesson number 4. If we can recap what we have looked at so far, we have looked at the purchase of own shares by a company, where expressly such purchase has been prohibited, including the financing of the purchase of the company's own shares. But we have also looked at exceptional circumstances where such purchase can be done and the financing for the purchase can also be done. We have also looked at dividend, what it is. We have looked at the rules relating to payment of dividend, and we have also made a mention of the procedure to be followed by companies when paying dividends. I now want to send you to the revision partner questions, just to show you some of the questions that we have had from this particular topic. We have a question here asking candidates to advise shareholders on the distinction between nominal capital and reserve capital. We have a question asking candidates to explain 5 ways in which a company might alter its share capital. We have also a question here asking candidates to discuss the actions and omissions that are considered to contribute to criminal behavior in relation to preparation and issuing of prospectuses. So there are many questions here that I would wish to refer you to help you in the revision of the content in this topic. Thank you.